Welcome once again to your digital deep dive. This is your deep Web3 secrets. I'm Alex Trapp,
And I'm Spirit Surge.
and we have got another excellent topic for you today. Today we are diving into DeFi, decentralized finance. What is it? What does it mean? And what is new about it? So, as we get started, Spirit Surge, how have you been this week?
Oh, I've been good. How about yourself? How's the weather back in Colombia?
Really great. We are in high summer. We're getting some sprinkles of rain at night. That's good for the plants. Everything is going great. I might even have to start a podcast about our farming. It's very good stuff here, but nothing really related to the tech. So let's jump right into it. What is DeFi?
Decentralized finance. So, back in the day, everyone used to say, I mean, we're talking about 30, 40 years ago, when people used to say, hey, you have extra money, put it in the bank, right? You're going to earn interest off it, and you're going to make that, 0 point, I don't know, 1%, 2% in a year. And that seemed to be like really big, and people were crazy about but the problem was it was centralized. Like the bank controlled who earned what, right? And they could change it whenever they want, and no one could do anything about it. So, what was the solution that you know the investors insisted on? And that was having a system, having a finance system where they could put in money, right, and earn off it passively. But it is something but it's decentralized, meaning no one can interfere with it, and it's like working on like smart contracts, and it's like trustless systems, and that is the thing of the future. So decentralized finance is specifically defined as that, where you can put in money in any project, you can make passive earning from it, and system is trustless, no one can interfere with it, no one can change.
Okay, so this is kind of reminding me of our discussion about games. So I put money in the bank, and the bank is, with their centralized database, accruing interest to me. Where does that interest come from? I mean, in the bank side, they're probably lending it out, they're earning it somehow. But if we take that all the way back to the central bank, where does new emissions come from in centralized finance?
um so it varies from country to country. Most of the countries, when they're in a state of quantitative easing, that's when your interest rates, from loans are high, where they basically insist on people taking loans. Now you're going to say, hey, what does loans have to do with putting money in your bank? Well, the interest that is earned from these loans is one of the ways that they use that interest to pay off to people who have their special savings accounts, or the special earning accounts that they have. Varies from country to country. If I were to take the country of Saudi Arabia, since Saudi Arabia, each bank has their own investment. I put that in inverted commas, right? They have their own investment like systems where people put in money, and then the bank uses that however they want, right? And then you get a return from that, or you don't get any return from that. So what happens in that particular scenario is that the money that is coming is it's balanced out. It's coming somewhere. Someone is losing money, or someone is paying extra. So they're paying either interest on loan, or they're losing money in these investment schemes, right? Saying bank just says, "Hey, the money's gone." You remember the South Park episode? I'm not sure if you're aware of that. There was this episode where they try to teach his Randy tries to teach his kid to save money in the bank, and what happens is he puts the money in the bank, right? And the banker just says, "Hey, I put it in the investment scheme, and your money's gone." Right? It keeps repeating that, saying that your money's gone, your money's gone, your money's gone. Essentially, a bank run. So that has to be sustainable. If it's not sustainable, if everyone starts taking their money out, right? Or if the earnings of the payout are matching to what the bank can pay, then that results in a bank run because the bank runs away with the money. So yeah, centralized finance is not as trustable as it used to be, especially after the 2008 crash.
That was a big turning point for sure. And I think it's no coincidence that Bitcoin was born right after that crash or in the wake of that. Now, I understood, and maybe this is coming from the United States perspective, I understood that the central bank prints more money whenever it feels like, and it loans it, maybe at a very low interest rate, to the banks, who then loan it to somebody else at a slightly higher interest rate. And in this way, money enters the economy being loaned to us. So, at a certain extent, the interest that we are getting on our savings account can trace its way back to central bank printing. And the central bank printing, the new emissions, enter the economy through banks, so basically through the richest members of society. Now, these decentralized communities have new emissions, they do produce interest, but they programmatically or they contractually or algorithmically determine who's going to get the interest, and that can be reviewed. Am I on the right track here?
Well, yeah, obviously. I think what you're saying is totally in line with why everything was born, why this decentralized finance has made such a big space in the crypto world. I mean, it's a giant part of the crypto world. Sure, we were talking about NFTs last time, but DeFi is just as big as NFTs is. We're talking about millions and millions of dollars here.
So it's a huge part. It maybe even was the backbone of the last bull run, DeFi. And so it continues to be big, but we saw a whole bunch of rugs, I guess you would say. We talked about rugs. These were not slow rugs, these were algorithmically designed rugs that eventually, early or later, disappeared with the money. So a lot of people said, okay, it sounds interesting, but it's completely dangerous. We should never do DeFi. So I think between those two extremes, we need to find a middle ground. Is this safe? Is this a place where somebody could treat like a savings account? I mean, what are some of the heuristics you use when you consider if a DeFi project is a safe place to put some money?
Okay, so one of the biggest things, right? And this is me coming from me who is a dev, right? Who knows Solidity, who can understand smart contract code, right? So I can look at a code and I can tell if this project is safe to invest in or not. But 99.9% of the people who are going to put money in DeFi have no idea if this project is safe or not. All they have is to blindly trust the guy who's tweeting. Normally, the guy's not even doxxed, right? It's like someone is tweeting from an account and apparently has big enough influence. People say, you know what, I trust this guy because he got something right once or twice, and here, take my money. But that is not the best way to do things. So, so okay. So let's talk about what normal people heuristics people use, right? What is the heuristics normal people use? So people say, okay, is the guy doxed? Okay, he's doxed. Does he have a company? Okay, he has a company, right? Has he run a project before? Was it successful? Oh, okay, he has done that, right? So that's like the normal people thing. Now, but when you're going to DeFi, you have projects where the guy is in doc, and they say, okay, is the guy doc? So he's not doc. Yeah, okay, so he's not doc. So what's my next heuristic? My next heuristic is who's investing into this project? Which big name or which big YouTuber or which big influencer is investing in this project? Because they always assume that these big influencers or these big YouTubers are going to do their due diligence, the due diligence that they can't do. But that's not right either, because these influencers or YouTubers have been paid to shield the project. And what happens is you end up losing your money. It's inevitable, right? You very rarely get it right. You're always exit liquidity for someone else. It's why so many people, and I'm talking about 70% of the people who leave crypto is because they have become exit liquidity for someone else in DeFi or in trading. So these like are massive, dangers of DeFi that comes with that. In terms of the heuristics I use, I prefer looking at the code myself and looking at the audit report. So a lot of people might not know this, but there are companies like Paragon, Rug-Free Coins that do audits on smart contracts, right? And these are publicly available. You don't have to, you know, uh, blindly just invest in a project. You see if the project is audited. That's the first step. If the project is audited. If the project is audited, great. Look at the audit report. The audit report is broken down for the average layman of what's dangerous, what's not. And, like for the sake of this discussion down the line, I will go through one project, right, just to show you it's a DeFi project, a famous one that resulted in essentially a rug happened. It became a rug. So I will run through that later down the you know this discussion. But the heuristics that you need to look at is the project audited? Yes. If it is audited, look at the audit report. What do the auditors say? So that those are like the first two heuristics. Don't care if the guy is charming enough. Dupont was charming. Don't don't care if the guy is like a genius like SBF or a perceived genius, right? None of that matters. The only thing that matters is what does the code say? You are looking at DeFi. DeFi means trustless systems. That means immutable smart contracts. So that is what people need to look at.
Okay, so that is great, and I really want to do a deep dive on that in a future episode. Really get look into the audit reports and maybe even some code. But let's continue here on a surface level. Let me talk about one very popular project, Uniswap. They made something called they kind of brought to the forefront something called liquidity pools, which involves matching two sets of assets against each other. And I've heard people refer to this as infinite liquidity. The old tool that's still really used in Forex are market order books. And so the liquidity pool is a new way for assets to be priced. And Uniswap was one of the biggest ones that came out during the last cycle to do it. A lot of people have copied that. The code is open source at this point. So, and if I'm correct in this, liquidity pools charge a fee to swap. So the earnings are not necessarily based on an inflationary model. Is this a more sustainable way to DeFi, do you think?
So the interesting thing about liquidity pool, right? Even if you were to take the current DeFi projects that exist, uh, if I were, let's say, let's say I'm taking a decentralized project, right? Let's say I take this project called Placid, right? Now, sure, I like do the DeFi thing. I earn 2% on a daily basis, okay, and that's cool. I get Splassive out, okay, but now where do I trade it? I have Splassive token. Where do I trade it? I mean, it's not there on any centralized, uh, you know, exchange. It's not on Binance. It's not on what we call Coinbase. Where do I do it? What I do is I go to PancakeSwap, which is just like any swap, has a pair built up with BNB. I then convert using that pool and paying a 1% minimum fee to convert my passive into BNB. The BNB, which I will then change on the centralized exchange like Binance into BUSD, and then turn it into dollars in real life. That's the process. So what liquidity pools have actually done is they have allowed the average Joe or the average developer to create a project and to create a way that you can turn your spending into a more centralized token. I use the word centralized here, or stable coin like BUSD, BNB, or Ethereum. So that's what LPs have done, and LPs are a necessity for any DeFi project that exists. Unless, of course, you have that particular token on a centralized exchange like Coinbase or Binance.
Okay, excellent point because getting listed on Binance or Coinbase is quite a process and usually costs a lot of money. So, what we're saying is that not only are liquidity pools an interesting tool, which we might even talk about a little more about how they work, but they're a way for small projects to basically for free, if I understand it, provide some way to get in and out of the token. Is that right?
Correct. But one of the things I really need to point out here is that for these pools, the liquidity has to be provided by the little guy. Someone has to put in liquidity. If you are unable to procure liquidity for this project, your project will die. There is no way to survive.
Okay, right. So that is the key. So let's talk about some of the terms around liquidity pools. So the first one is, I would say, depth, the depth of liquidity, how much liquidity is available. And so if I'm understanding right, a liquidity pool will always have 50% in one asset and 50% in another asset. So let's take a simple example like a stablecoin pool. We've got Tether and you mentioned Binance Dollar, Binance USD. So, some amount of Tether and some amount of Binance USDs. I mean, they're both supposed to be worth $1. So we can use simple numbers. Let's say if there's $100,000 of liquidity, that would represent 50,000 Tethers and 50,000 Binance dollars, right?
Right?
Okay, and so then anybody with a Binance dollar wants Tether can switch, and anybody who has Tether wants Binance dollars can switch, and so that liquidity can slosh back and forth. Now, one thing
Mm-hmm.
about liquidity pools that I know most people struggle with and even are afraid of is impermanent loss. So, do you have any
Mm-hmm.
thoughts about impermanent loss? I have some thoughts, but I kind of want to hear as a developer, what do you think of when people talk about this IL, impermanent loss?
So I'm just going to take a scenario when a bear market is going to hit. So you have a token which is you have like a total you know liquidity of $500, which is $250 X token and $250 in stable coin. Now, when the bear market hits, uh, the price everyone is just rushing to sell because it's a bear market. Everyone is rushing to sell, so everyone starts selling the X token, right? They're either selling it on the market or they're exchanging it on liquidity. What happens then is to balance out the equal ratios, your value of Binance USD, right, turns more into the X token because the X token is obviously dipping away because people are exchanging that. So what happens is your $500, right, becomes obviously it drops, and because the value of the token is dropping, and the stable coin pair has to match that value, and you end up with $300 worth of stuff, but you don't have 150 USD. you don't have that equal ratio like you expected. You're going to have this X, a lot of X tokens, right? Maybe the same amount that you had before, but because the value is so inflated, you have this huge amount of X tokens with a very low down value, and you have this stable coin, right, that you were so happy with the beginning, but now it's not even the same value that you were expecting when you put in the liquidity pool. This results in impermanent loss because you now have this huge amount of tokens with an inflated value, and you can't do anything about it except sell, causing more loss for someone else. This similar scenario replicates itself in a bull market, right? And that's when people are starting buying the token. And it's the same thing. And this is what we're talking about as stablecoin. Let's talk about something that has two different X token pairs, and none of them are pegged to USD, right? What happens then? Well, you're going to have this huge problem where your tokens are consistently shifting themselves based off, the value of the token. And you could end up, if you had $500, you could end up with less than $100 in a bear market, because if everyone is selling the token price as well, and the liquidity pool have to reflect that change. So you might have the same amount of tokens as you did before, but because the token values are so inflated now, the token volume is so inflated now, everyone's selling it. The value is just abysmal, and that is a risk of DeFi. Whether you're doing it in a bear market or you're doing it in a bull market, there's always a risk. Impermanent loss is one of the many scenarios that presents itself, you know, to damage people. What are your thoughts on it? Since you have delved in so many liquidity pools.
Yeah, I do have a lot of thoughts, and I love liquidity pools as this new tool. But because we're experimenting with this technology in a decentralized space, we've had the opportunity to watch almost everything that can go wrong. So let me back up a step. So if impermanent loss, it kind of makes sense intuitively if you think about it like this: when somebody sells their X token for Binance dollars, they're taking Binance dollars out of the pool and they're putting in the X token into the pool. And so the more people that do that, the price of X token will go down in dollars. But so people are increasingly putting in more and more X token to take out less and less Binance dollars. And so you get to the point where it'll always be the case that uh, the less valuable token, you will end up with more of it. So, in the case of a bear market, this is the worst of all scenarios. You end up with very little dollars in the pool and a lot of this X token. But this same thing can happen in the bull market. So one of the tokens goes up and you think this is great, but it turns out now you have less of that token. You have more of the other token. In the case of Binance dollars, maybe that's not so bad because you at least you have dollars and more of them. But if you are matching two different X token pairs, you are always going to end up with more of the less valuable token. So there's some situations where this can be good, but it always depends on you, the person. There's no JP Morgan that's approving these pools, which pool is a good idea, which pool is a bad idea. You must carefully select the pairs that you invest in. So stablecoin is good on one half. At least that mitigates the bull market risk, where at least you end up with more dollars if the token goes up. But in a bear market, we have some serious risks either way, which you enumerated. Um, I consider a good pool to be one where I don't mind holding more of either one of the tokens. So let's say you enjoy a certain blockchain. Let's call it XRP, Ripple. I'm a big Ripple. I'm not personally a big into Ripple, but some people are, and good for them. So if and we know that Bitcoin is probably one of the kings of the space. So if you were to match, you like Ripple, you like Bitcoin. If you were to match Ripple with Bitcoin, in a certain sense, you don't mind having more Bitcoin or having more Ripple because you believe in both projects. So that is an ideal situation for liquidity pools. Um, and so I would just say be very careful of liquidity pools. This technology is very powerful. And I want to get into one of the reasons why it's so powerful. We talked a little bit about swap fees. So liquidity providers can earn fees based on people needing to use the service, wanting to move from one side of the bridge to another. Some of that has to do with arbitrage, which probably is a whole nother episode. But some of that has to do with regular people moving their funds around on the internet between different projects. So the swap fees provide value to the liquidity providers because they're giving a service. But now, additionally, many liquidity pools will provide additional rewards in terms of inflation. So this gets us back to the central banks. Currently, in the centralized system, central banks print money and give it, through the Cantillon effect, give it to the people closest to them. They give it to the big banks who loan it to the smaller banks, and but now in the decentralized world, projects can target inflation to people that provide value. They can give it to team members. They can give inflation to developers. They can provide bug bounties. And one of the places they seem to be providing value to is liquidity providers. It's a recognition that liquidity providers are providing value. And the theory is, which I do believe in, if we give new emissions to people that provide value, there exists a case, this is the hypothesis, where we can give people providing more value than we're giving away. So we can actually create a larger pie by targeting the inflation, the new emissions to people that provide more value than they're getting back. That isn't always the case. More than one project has diluted itself through inflation by providing that inflation to, let's say, poor value centers. But the theory is this, that there exists monetary policy such that we can give inflation to people who are providing more value than we are giving back to them. Do you have any real life examples where you think this has been done well?
So, so actually, I'm just going to take since you talk about real life. Corporates, they give bonuses to their best employees, right? Or they give larger shares to bigger investors, bigger sleeping partners, or sometimes to more active partners. So that's like a real life example of how things work. Just because the only difference here is in a decentralized exchange, you're using your own economy, right? Sure, you can convert it to dollars, but you're just using your own token. Whereas in the real life, you're using actual US dollars. So this is something that's been happening since forever, and indirectly in one way or the other. In liquidity pools, right? And liquidity pools essentially was created out of necessity. But now what's happening is that people are seeing how they can use it to further create utility for their project by giving, rewards, giving incentives for people putting in liquidity, right? And then now that so the first layer was people creating LPs because of necessity, because well their projects need to exit because they can't afford doing centralized. The next level was incentivizing people to put in liquidity. You'll often find stablecoin pairs on exchanges that literally just give out 10% APR, but you'll find a lot of liquidity and there are people who are putting it. Like, why would you want to put in something like a swap BUSD or swap whatever, sorry, a BUSD or a TUSD or a USDT pool? Why would you want to do that? Well, there's an incentive for it. So you do that. Sure, it's 10% APR or 1% APR. We don't care. It's incentivized. And then what happens is the layer on top of that is what you're talking about is uh, you know percentage fees that these people get because they're people trading into the pool. And then there's another level on top of that, since people are ingenious and they are finding new and new ways to incentivize things, is adding a bonus percentage based on how many days your pool has liquidity in it. So let's say you put your pool in. Let's say you put liquidity in a pool in for 100 days now. Well, on the 100th day, you're gonna get 100% increase on the trading fees that you're getting like a 0.1 trading fees that's coming to you. There's gonna be 100% increase on that, and that is just amazing how people are utilizing something that was created out of necessity to something that is now a normal utility. And then now there's the next level. There is further rewards for people who have put in liquidity in different things. Like if you go to app, right? App, for those who don't know, is an exchange service where you can take uh, you know, loans by staking something. But if you already have liquidity in those pools, you get a, like, literally you don't have to pay any interest fees to take a loan, and that's amazing if you want to do a quick exchange from one currency to another on from one chain to another. So that is just one of the utility percentages we were talking about. So there are like tons of other utility. I know there are people who have received, like for NFT projects, have received NFTs, right, from, I don't know, for their project or for other projects, for putting in or providing liquidity for that particular pool, because obviously it's a very important part. It keeps sustainability for the project, and the project doesn't have to die. So this topic about LPs, the reward structure, what can be done to create more rewards, what can be done to create more incentives, or how to use it further as a utility, is a huge topic, and we could probably talk for hours about that. We should probably do another episode just for about that.
This episode is brought to you by Surgent Gaming. Join their Discord today to play their Astral Wars game. They are ready for you to test. It's coming soon to Google Play Store and Steam. Link in the description below. Join the Discord. Surgent Gaming's Alpha Wars, a combination of Yu-Gi-Oh and Hearthstone. Okay, I want to get into D no, gamified DeFi. So you mentioned several layers here, and I think that is going to lead us right into this gamified DeFi. So this is the cool thing about decentralization. In the last bull run, we really stress test maybe the first layer and getting into the second layer of these things. But now people are building increasingly more complicated layered structures. And it's really starting to get exciting for us spreadsheet guys. But in a certain sense, I wonder, is this going to get too complicated for the average person? Maybe that's where gamified DeFi comes in. Um, some of this could be educational, some of this could actually be a game. Where does your mind go when we talk about gamified DeFi?
So this is actually a very interesting topic. I came across this project. Um, what it did was it had this pig, right? And what this pig did was it ate truffles. And then what happened is, with selling those truffles, you could buy more pigs, right? And then that creates a cycle where you have this ability to keep buying pigs that eats truffles, and then that can be circulated. It's similar concept. There was another one where there's a fisherman catches a fish, you sell the fish. Now you can decide whether you want to buy more fishermen or what you want to do with it, right? It creates a cycle about things. So even if you have something very complicated, right? And all of these projects that I'm talking about aren't like, it's not simple math. It is actually very complex because it talks about compound interest and compounding, the effect of compounding, which a lot of people say like the eighth wonder of the world. Uh, so it has already started in 2000. I think 20 was the first one that came out, and that was like really famous. And then things started coming out after that. So what happens is, now just to clarify, these games that I'm talking about, eh, you can't those truffles that you're getting, like that the pig is eating. Uh, what you're doing is you're converting those truffles back into actual the game token, right? The game token can be called anything. It's not going to be called truffles. It's going to be called something else, right? Belongs to the project. You could call it fish for all you care, even though you like has no relation to the token itself, to the game itself. But the fact is, because it's gamified, and because people are able to throw in not even one, not two, not I have seen projects that have thrown in four tokens, four different type of tokens in one project, and they are trying and they're balancing it through this gamified way and using LPs to manage the values of all the tokens, right? And you're saying it's going to get complex? Yes, but the way it's going to get complex is not because of the the game part, because there's a limit. Unless you are an actual game developer and a game designer, you are not going to create something that is really fun to play, and you're going to have this tokens that you can really manipulate however you want, or the people however you want. No, what you're going to have is a system where you're going to have increasing amount of tokens in the same gamified cycle, and the developer or the owner of the project is going to find new ways to balance the prices of token in respect to each other. So that's how the complexity is going to be born. If the day comes when there is a game that's fun to play, right? And it can manipulate the person, the player, to doing specific tasks. You can create, and this is my theory, you can create an ecosystem that is going to be sustainable, and to the extent that there's not going to be a massive increase or decrease into the value of the tokens. This is my belief. Uh, has someone done it yet? No, because there is no way for anyone to predict how millions of people are going to respond to to, to the market. The same way like the stock market has been trying for 60 years, trying to predict how millions of people are going to interact if a war happens, or if this happens, or if that happens. And it's very seldom that the machines or the people get it right.
Oh, so many good points there. So, one thing I like that you said, first of all, DeFi is gamifying, but in a sense, it's not really a game. Winning the gamified finance means you're making money, I guess. So, really, the scorecard is you're a financial thing. But games are also heading in the same direction. They're trying to financialize their games, and since they are already games, it's in kind of a gamified way. So, and I also like that you, as somebody who builds games, clearly admits that nobody has done this right yet. We don't know if we need 4 more years or 10 more years for somebody to get this right, but there are a lot of people working in the space, and they're all after this holy grail of a sustainable game economy where the game is at the same time fun, but people are financializing in the sense of maybe a sustainable economy doesn't mean that anybody goes to the moon, but it does mean that when I'm done playing, the results that I've earned, I can sell on to somebody else, get some of my money back, a rebate, or if I've done really well, perhaps get a little more money than I put in. Um, so this is interesting. It makes me think about Axie. So Axie Infinity, I never really considered it a game, although there was some gameplay. To me, it seemed like uh, a little bit more advanced gamified finance. So your pets produce love potion, and love potion is needed to buy pets, but you could also sell the love potion. I mean, so would you agree that Axie really never was a fun game? It was more of a gamified finance, or am I being too harsh with them?
So Axie was the first of its kind that basically tried to go into the next level of gamifying stuff. And they managed to create a turn-based system game that had, that used the NFTs, right, the way they were supposed to be used. But the problem was they created this system where people could only uh, spend it on the same thing, right? The utility was consistent. The utility never changed. So what happened because of that was the price ballooning to the moon, right? And a lot of people think, oh, that's a good thing. No, that's not a good thing. That's a horrible thing for a project. If a project price is going to the moon, it creates attention and it creates distraction. A distraction where the guys from Annie Ronin, right? They had to end up firing some of their own guys because they were suspected in, trading their shares or trading company shares in different setups, right? And that was a distraction. The attention is because their blockchain got hit by $400 million attack and exploit. It brought infamous attention of hackers who saw that there was a security exploit in Axie, in the Ronin bridge, and they used that to exploit the system. So having something that balloons the price to the moon for your token is never good. Axie got onto the next level. They should have remained consistent with the development and they should have created more utility. If you have a game, right, it's the same thing. You have truffles, you can only buy pigs. Well, what's going to happen? If you can only buy pigs or turn it into money, right, you're going to keep buying pigs. It's the same thing here. What are you going to do? You're either going to turn it into money or you're going to keep buying Axies. And that's what happened. People started buying Axies, breeding more Axies, and that was just to find that perfect, Axie with the traits that people can use to climb the ladder and get rewards. Again, rewards, a lot of earning with utility being minimal. And that is the problem with gamified finance. So I think you're perhaps in essence, in concept, are right with saying that this resulted in the same like any other project. But if I were to actually look at the project itself in a bubble, then it went to the next level. It taught people what they need to do. It taught projects what they need to do, how to do it. It's just they fell short because they got distracted and they like infamous attention was created that brought in the bad guys. And if there is any project that says, "Oh, we're not hackable," trust me, there is every project has a security exploit or a security flaw that cannot be dodged. Every project. There's not a single project in the world that cannot be exploited. You need someone on the spot, right? You need to have a full security team on, you know, on payroll to actively take care of projects to ensure that they are not exploited in any way.
Another ton of good points there. So, one thing I like that you're saying is that, at least in the game world, to the moon is not the goal. Really, what games should be looking for is stability and probably gamified finance as well. Um, when the price goes to the moon, we're distracted. It's less of a game and more of a finance project. And now suddenly it's a honeypot. A honeypot is something that attracts ever more and smarter people to try and hack, to try and exploit. And I think you're right. The funny thing about trustless is we can trust the code, but hacks and new hacks get developed all the time based on incentives. And so a larger pool of money, they call this a honeypot, it becomes ever more attractive to spend time trying to figure out what the exploit is. So, and the last point that you made, really good. So maybe I was a little harsh on Axie, but it's somewhat true. But the key is this is such a new space that every success, which some ways seems like it turns into an eventual failure, is a lesson learned. So we're still learning in this space. The developers and hundreds of teams are doing the best they can, and every episode becomes a lesson. And so ever more advanced and complicated systems, not necessarily complicated, but complex systems are being developed based on the lessons of the past. So this brings me to a point that I mention all the time. New people come into the space. This is the space. This is great. Everything's exciting here. Let's do this project. Wait a second. Let's review the best practices. A lot has been learned. Do not come into this space and think that you can make the same mistakes as past projects and that people won't notice. Everybody in this space is learning as we go, but we're very aware of the lessons of the past and we're very intent on not repeating it. Again, the counterintuitive point that a game really shouldn't be trying to moon the token. It should be trying to achieve stability is a lesson that I almost want to say is kind of new because everybody thought that Axie was winning when that price spiked up. And there was a lot of talk about scholarships and this is something that Filipino people, uh, probably people around the world, but Filipinos get called out a lot. They're now, this is their job. Their job is battling and breeding axes. And what a strange world. And if we really analyze that, what value are they providing to the world? um, right? I mean, we could work as a virtual assistant on Upwork and transcribe things. I mean, that's real work. But battling and breeding NFTs, what is the value they're really providing? And so that seemed to me unsustainable at the time. It proved to be unsustainable. But that doesn't mean that this whole space is without potential. There's a lot of potential and lessons continue to be learned. Are there any lessons, best practices that we haven't mentioned today yet? Anything that's on your mind still?
Uh, we've already mentioned it, but I want to rehash it because this is so much important. Audit reports every token, every famous token on uh, Ethereum, on Binance, on DeFi projects have an audit report. Go through the audit report. It's very important. I'm sure in the next episode I will be able to like go through in detail about several tokens. But even something like Peep 2.0, right? Big token. Everyone's like getting into it, and there's like a 11 $11 million market cap, and a lot of people are investing in it. Is that a good project to invest in? In my opinion, no, because I went through the audit report and I found out that the owner of the project has 11 privileges, right? And there is a huge centralization risk. He can turn off the contract at any time. He can enable or and disable trading at any time. He can change the buy and sell fees, up to a 5% maximum. They can disable swapping uh, in 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 uh, in any of the liquidity pools, and that is a huge thing. So if you see someone on Twitter saying, "I made money off PEEP 2.0," just keep in mind that tweet is bait for people to invest and become exit liquidity. Always look at audit reports. I will. I think we need to go through this section of audit reports as soon as possible, so that I can tell people or tell what my findings are. I can understand quality code, right? But there are already tools available since 2020 that people can look to see if a token is worth investing. So if you get alpha, and you're not the first one, just keep in mind, if the audit report says that there's a high risk of owner privileges, that could mean you could get drugged pretty easily, or that could mean you could become exit liquidity for the owner. And I want to, like, really, really rehash this point. Go through the audit report. Don't ape into a project, because if an audit report is available, you're literally a bloody ape for putting, like, investing in a project without going through the audit report.
Okay, great points, and maybe we should let's do that next episode so you have some time to prepare. This is a topic that I am particularly interested in going through with you. I am a person that does wait for audit reports. I have read some audit reports, but I generally trust what something like Certifique or these big companies say, because I'm not personally able, I don't have the skill set to actually go through the code. So I would love to walk through that with you next episode. Let's plan that. Another episode that came into my mind in this was a deeper dive into specifically liquidity pools and terminology and considerations when getting into the liquidity pools. It's one of my favorite things, and something I've had a lot of success in. But success uh, identifying the things to avoid, because not all liquidity pools are created equal. So I think this is very topical, very well timed that we do some of these episodes, because a lot of excitement is starting to build again. BTC is trading sideways, but development is still happening. Bigger players are moving into the space. A lot of new projects are coming back. Old projects are starting to show up with updates again. So I think this is really timely. Would you agree, then, Spirit Surge, to prepare something for us, to really dig into audit reports and smart contracts in the next episode?
Sure, and I think it would be very, very wise if we were to go through audit reports every week for newer tokens, because there are tokens that are available that are coming out on a daily basis, right? And a lot of people think, hey, should I ape into this project? Does this project have utility? Is this project something that's going to moon and I'm going to make a profit on it? I'm sure a lot of people have these questions, and I think the one of the biggest things that people wonder about is, hey, how do I find tokens to invest in? So if by on a weekly basis going through the latest audit reports of the latest tokens will just give you an idea of how to identify projects that have future growth, and also will identify whether this project is something worth investing in to turn a profit in the bull market.
Fantastic. That's a great idea. We may end up having to do this podcast twice a week. This is fantastic. Now, a little bit of housekeeping work for you all. Make sure to follow us on Twitter, subscribe to our YouTube channel. The episodes currently are becoming available on YouTube 1 week after we publish them. We are trying to grow our presence. If you're listening to this right now, make sure follow the links in the description below. Subscribe to our YouTube channel. Get after us. Follow us on Twitter. We've also discussed possibly as we work through some of these basic level things to open up maybe once in a while, once a month, Twitter Spaces where people can offer their questions. We have a lot planned for you. We're really excited about this podcast. If this podcast is providing value to you, uh, do the social things. Follow us on Twitter. Ask us a question. Leave a comment. Let us know what you want to hear from us. We are excited to be building this up at what we think is the right time to give maximum value back to the community. This is not our first cycle. It's coming up on my third cycle now. And so we have a lot of information and we'd like to share it with you. If this is valuable, do those social things, give us a follow, give us a like, and stay tuned for next week.